So certainly the last few weeks and the last few months have been a little bit of a bumpy ride for investors, especially if you might have got started towards the end of 2021 or even the start of 2022. We had that big sell-off as the markets entered a kind of correction phase, especially in the US with the Nasdaq and the S&P 500, and many popular growth stocks which did really well through the 2020s and 2021 have come crashing back to earth as investors have fled to stocks that have given them free cash flows and given them something called profit. But no need to talk about that. So I wanted to do a couple of things in this video because I think you'll probably see a lot less portfolio updates from your favorite UK creators, certainly over the past few weeks, as of course their portfolios have taken quite a big hit, as we all going to take a big hit as the global economy has seen some shaky times, especially over the last week or so with the Russia-Ukraine conflict, which has not been going well for prices. But in true transparent fashion, I wanted to share also my journey with you to show you that I'm not immune to the prices and the fluctuations, the volatility of the stock market as well. But for me personally, in my opinion, ultimately, I know that stocks go up and down. They do go up more than they go down over the long term. Anything can happen, of course, in the short term. And ultimately what that means is that I'm able to buy into the stock market at lower prices. So in 20 or 30 years time, actually that will give me more of a benefit rather than things going up and having to FOMO everything into the market. But just before we jump into the numbers and see how that's affected my current portfolio in my Vanguard ISA, just wanted to comment on a couple of things going on in the global markets at the moment, and actually maybe try and give some reassurance to new investors, certainly if you are looking to start now, and not let these kind of things put you off, because I am kind of passionate about making sure that everyone gets their money into the markets and working for them as much as possible. Let me just first take you back to a quote around war and around buying and investing during war by Nathan Rothschild. And his quote says that you buy on the sound of cannons and you sell on the sound of trumpets. And I guess what he means by that is the stock market is a very volatile place that hates uncertainty. So when anything happens in the world which can cause any kind of uncertainty, which includes war or any kind of supply chain issues or interest rate rises, that the market reacts somewhat irrationally and will oversell or overbuy depending on which state of mind that the people are in at the moment. Unfortunately, as retail investors especially, we get caught up in that euphoria and buy on the way up and sell on the way down, when actually what this quote is referring to is that you kind of want to do the opposite. But if we look at this quote a little bit more in depth and understand actually what do we mean by the effects of war on the stock market, you can see historically what's happened is not been as much as you may expect. In fact, let me just pull up some research on screen now from LPL Research, who've looked at the effects of war on the stock market. And as you can see here from all of the different events that have gone on throughout history over the past 100 or so years, including the major world wars and different things like the attacks on Pearl Harbor, the North Korean missile crisis, and certainly the bombing of Syria and even the London subway bombing, you'll see that on average, the one-day drawdown on the S&P 500 index has been about negative 1.2%, and the total and the largest drawdown on average has been 5%. And actually then to recover, it's taken only 47 days to get back to those all-time highs again. And I think that's quite interesting because I think a lot of people must think that the market is going to all of a sudden crash 30, 40, 50%. And this, of course, generates more fear, especially if you're a newer investor. You think, well, I'm just going to keep everything in cash. And as we know, keeping things in cash is not a great play because, of course, that cash gets eaten away by inflation. So we only want to keep cash for things that we actually need. Secondly, a quick comment on some of the commodity prices that you might have seen change recently. So gold, of course, has seen a bit of a resurgence as Russia entered Ukraine, as investors look for a bit of a safe haven for their money. Now, it's quite an interesting one because gold hasn't really done much for the past 20 or so years, as you would have seen. If anything, people have got more excited around the cryptocurrency space. But gold has historically been an asset class that people move as a flight of safe haven and put their cash in. And this we've seen, I've put that on screen now, the charts, we've seen gold go up 8% over the last month and 4% in the last week, which is certainly a big move for gold because gold doesn't really move much in terms of its amounts per day. But if we then take a look at oil, for example, we've seen that oil prices have taken certainly a big leap. But let me just make a couple of observations certainly around the prices of oil and the prices of different commodities. US reliance on oil is certainly nowhere near as much as it is in Europe than when we're talking about in relation to Russia and the supplies from that side of the world. In fact, the US is a bit of a net exporter in oil. When I was looking at some recent data, their main import partners are Canada and Mexico, and of course Saudi Arabia. And they don't really rely on Russia for their supplies of natural gas and oil, because of course the US is very lucky to have its own reserve and its own lucky geographical place in the world. It's only really countries in the European Union in that area, of course, including ourselves, who rely on those supplies of gas and oil from the region of Ukraine and Russia. And we're currently relying on them to supply about 35-40% of our gas and energy resources at the moment, but we are well diversified in terms of other places that we can get it. So of course the European space is going to be more hurt than somewhere like US. However, one interesting comment just before we jump into some of the numbers on the Vanguard portfolio is that you would have seen that cryptos had a very interesting rise over the last few weeks. We've had Bitcoin and Ethereum especially jump up double digits. Bitcoin's jumped up 14% in the week and Ethereum jumped up 10% in the week, which are huge leaps. But what was interesting is to see these commodities initially sell off at first, like the rest of the market sold off in the fear of war, but then actually investors jumping in and potentially Russian investors jumping in and people from Eastern Europe concerned about the price of their currency as Russia was cut off from the SWIFT system, with assets clearly pouring into Bitcoin and Ethereum and other cryptocurrencies to boost that, while of course assets like the ruble would have gone through the floor as Russia has been cut off from the international monetary system through SWIFT. So let's jump straight into the numbers here on this Vanguard ISA that I have set up. You can see that I actually have put in another £1,000 into this ISA as the markets have been depressed, although I am going to be putting in money regardless of the prices. Let's just jump into some of my holdings here. As you will see, it's quite a simple portfolio, which is how I like things. Certainly you could make it even simpler with just a global ETF or a global fund. But what I'd selected to do, and I initially started this with £10,000, I stuck in 8,500 into the S&P 500 ETF, which is VUSA. And then I did a 1,500 into the FTSE Emerging Markets ETF, which is VFEM, which you'll see on screen now. As you can see, the performance hasn't really changed a huge amount. At one point, I think we nearly touched 11,000 from that £10,000 initial investment as the markets were rallying. We did have a slight pullback, so I was actually losing money at some point, but over the last few days, it has recovered again to a small amount. So you can actually look on the chart here. If you have your own Vanguard portfolio, you just go to the performance tab here. You can see my initial £10,000 investment and how that's changed over time. And you can see where it's peaked around the start of December time as the markets were in a very euphoric phase and everyone was very excited. And then since it has had a little bit of a pullback as we had that start from 2022, and it did hit under the £10,000 mark on a couple of occasions. And then I did put another £1,000 in recently to bump myself up. Bottom line here though is I wanted to address a couple of different points. Now firstly, of course, as I mentioned at the beginning, you're probably going to see less portfolio updates from creators as their portfolio is taking a massive hit, especially if they're in lots of different growth stocks. No one likes opening a portfolio and so showing that they're 50, 60, 70% down and then trying to justify their positions and not putting any more money in. What I wanted to show in this portfolio is ultimately, as a long-term investor and someone who's been investing for a long time in various different platforms, in and out of the market multiple times as well by many, many mistakes for sure, that the market does go up and down. And the biggest concern and the biggest fear from my perspective for newer investors is that they put money into the stock market as they're just starting out and they see their money go down, at least on paper. And of course that breeds a lot of fear, and at that point you end up pulling money out and selling because in your head you're concerned that you might lose more. But of course we know that in the short term anything could happen. Now if things were going to go the other way, which they did throughout 2020 and throughout 2021, people of course were obsessed. Any stock was going up, you could pick any stock and make a lot of money potentially if you jumped in and out of the right time. But as a long-term investor, actually dips in the performance of the S&P 500 that I'm involved with here, I'm not too bothered, I'm not too concerned. I sleep very soundly at night, and actually from my perspective it's a chance to buy this market at a lower cost, so my cost average will go down. So I know that over 20 to 30 years that this will be a very good solid investment. And while of course there's always a risk that it could go down and could go down even over that 20 to 30 year period, I know that if I dollar cost average and I invest monthly or whenever I have spare cash, that I put myself in a really good position to be able to grow my wealth. And you'll also know from my other portfolio updates of Hargreaves Lansdown, free trade, I've got some money also in stake and crypto, that I'm well diversified across lots of different asset classes, and this is just one part of my portfolio. Another thing I wanted to talk about too is just address something which I do speak out a lot about on this channel as well in terms of diversification. So you could definitely argue if I put my bear hat on for this portfolio and say I could definitely be more diversified in this portfolio. There is always a risk of concentrating a huge amount of your assets in the American market. Although it makes up around 60% of the investable equities around the world, that's not to say that the growth over the next 10 or 20 years won't come from that space. A couple of things you can argue, of course, the S&P 500 is well diversified in terms of it generates a lot of its money in international markets. And you could also argue, certainly in modern times, as it's driven heavily by the technology companies, that the world is a lot more technologically driven than it was 20 or 30 years ago. But it is something I do consider, and actually I have considered, and maybe I will at some point, is adding in a FTSE 100 or even a FTSE 250 ETF into this mix. So do let me know in the comment section below if that's something that you also think about. I am very conscious of not being too biased or not being too weighted in terms of where I have my investments. So I'd be curious to know what your thoughts are as well. Now, the reason I bring kind of diversification up is there's been research here from Hartford Funds, which shows that over time, the outperformance of international stocks versus the US has been quite cyclical. So if you have a look at this chart, which I'll just pop up on screen now, you'll see over the last 10 years, US stocks have certainly outperformed international by quite a long way. You can see here they've probably outperformed by anything from 5 to 10%. But previously, if we go back around the kind of 2003 to 2010 mark, actually international stocks outperformed the US. And again, if we go back further through the late 80s, early 90s, we'll see some big international outperformance by 15 to 20%. That's probably around the time I think the Japanese stock market did exceptionally well. As a long-term investor, of course, things will even out over time, but you don't want to have these periods where you say, if you're all invested in US economies and US equity, that you waste potential performance, and it may be better off, you may be better off to invest in a global stock market fund. So it's something I definitely consider and something I'm very aware of. And of course, this could flip at any time. Nobody knows what's going to happen in the short term. Anything could happen, certainly in that period of time. In the long term, though, of course, we're looking to get some growth. Just worth considering and thinking about if you are thinking about how you balance out your portfolio, not to be too concentrated in either space. There's also nothing to say that the US market won't outperform international for the foreseeable future and forever. But it is worth knowing that there's certainly some times when international can outperform the US. Who knows? You could argue it's different now. You could say these sort of things, but just be aware of that one. So final thoughts, plans moving forward. As you know, the tax year for ISAs will end at the end of March, at the start of April. So I may deploy some additional cash into this one to make the most of that tax-free allowance. I do have quite a lot in fund and share account in my Hargreaves Lansdowne platform, which is in a taxable account, and I wouldn't mind getting some of that potentially into this one to then bolster that. But we'll see how that goes. I have like to have a little bit of cash on the side for separate investments, and we'll see how this one grows. I'll keep you all updated. We'll see we're at 1.35% at the moment. You can feel free if you want to go back to some of my older updates, my past couple of updates where it nearly hit £11,000, and of course everyone's very excited. But ultimately, if I want to give you a message on this video, it's stay the course, invest consistently. Don't worry about the dips and the volatility of the stock market. Make sure you only invest with money that you can afford to have locked away and tied away, and ultimately make sure you have cash to pay for things in your own life, which who knows what's going to come up next. If you're buying a house, for example, I did a video recently talking about maybe times when you shouldn't invest, so check that one out. Either way, drop me a big like if you found the video useful and you've enjoyed the transparency, subscribe for many more, and I will see you in the next video. And as always, happy investing.